Shifting gears a bit, I have a question for Joe just about what we're seeing in terms of the pace of transfers to special servicing. What is Trepp tracking on that?
Well, interesting you asked that, Sam. Just looking over the past, say, since 2011, past 4 years, we've seen a marked decline in newly specially serviced loans and newly delinquent loans, which is, has been a great thing for the market. And, in terms of REO sales, in terms of loans being liquidated with losses, that has been a little bit less marked of a decline, but there's definitely been more of a trend towards slower months with special servicers working out loans. I'm sure Kevin can speak more to that, but the loss severities are a little bit static. I'd say they're coming down a little bit, in the 30 to 40 range. If you're looking at B notes and Hope notes, speaking of the creative stuff that was going on back in 2009, 2010, we've even seen a few Hope notes get resolved with less than 100% loss, which is not something we've been seeing, 1 or 2 years ago. So that's been very good. Where you might have been seeing, just looking at my chart here, 200 or 300 loans being transferred to the special servicer every month. Now we're seeing more like 75 or 100. And the same thing goes to, loans being liquidated. It used to be 1.5 or $2 billion worth of loans every single month getting liquidated with losses. And now, over the past, say, 12 months, I think it's 9 or 10 of those months have been under $1 billion, which is great, in terms of the market. Maybe the special servicers aren't happy because they have less work to do, but everything has been looking up. Not a lot of volatility right now in CMBS per se, and things are looking good. When CW Capital maybe comes to the market with another billion or so of distressed properties and auctions, we might see that number spike for a month, but I think in general it's been trending lower.
Yeah, and I think that fits with what we've seen in our own portfolio over, say, the last 18 months. We've seen a marked decline in the number of assets transferring in, both by count and balance. Still relatively healthy in terms of the overall numbers. And we've seen, a continued increase in our liquidations, so that the ratio has been, for us, about 1-to-1. I mean, the total active book really hasn't moved significantly since, late 13, early 14, because we've been pushing things through either through sales or mods or return to master. We've seen a pretty steady flow so far in 2015. We've been averaging, close to $300 million a month in transfers. Our anticipation is that will increase over the second half of the year, simply because most of the 05 deals that are maturing were back-ended to the latter part of the year. And we have been seeing some maturity defaults of 2005 vintage deals this year. Some of them are being resolved with no losses. It's just a question of timing. And I think the other thing that you see is a lot of the very troubled assets in these various portfolios, they've already sort of been through the process and are now gone. The better quality assets, a lot of those have already been defeased and they've moved on as well. So I think what you're going to see now is more, event-driven. A specific lease doesn't get renewed, or notice provision is given that they're not going to renew, or these deals that are coming in for a maturity default that need some time, or may possibly need some kind of a restructure. So
it's good that you mentioned defeasance. That's another thing that's been going on over the last, say, 6 or 8 months. We've seen record level defeasances as borrowers look to lock in low rates and refinance loans that maybe they may need to pay 2 or 3% defeasance. I guess you could call it a fee, but they're willing to do that in order to lock in the rates now, as opposed to waiting till 16 or 17, when who knows where rates are going to be.
Well, we've even seen defeasance on some new issue stuff,
like 2011 stuff,
2011,
right?
2012, where the number is very big, but because they can get lower rates, and because the markets are a little more liquid, they can get better leverage with property,
appraised values
improving
are higher
value, and so they can get more proceeds, and it's worth it to them.
Well, from a property management perspective, from 2010 to 2013, a lot of our business was driven by defaulting loans and then special servicers bringing us on, and that's really leveled off. So we've seen a steady decline because things have been picked up a little bit. So we've seen a steady decline in that part of our business, but those loans are now being sold, and so we're now seeing the new borrower bring us on as opposed to the special servicer. So there's definitely been some fluidity in that market from our perspective.
The new borrowers typically stay with the existing management?
In a
Especially if you
perfect
work
world,
with-
if we're not the original manager, we hope not. It really depends on who that borrower is. We are seeing a lot in the middle markets, so not in New York, but in the smaller suburban markets. We're seeing a lot of churn and buildings going to self-performers. So that doesn't bode well for us. If it's an institutional borrower,
What do you mean by self-performers?
an owner-manager.
I don't know.
If the property trades to a more traditional institutional manager, then in most cases there is a competitive bidding process.
What about in the case where you're engaged by the servicer and then the borrower works it out? Are you out the next day, or typically you gain confidence? Like during that is there a conflict of interest while you're working for the lender? Really, it's a...
You know what? That hasn't happened. Where we are working for the special servicer, the property has, if it's then sold, it's a competitive bidding process. There's no automatic. There's very little automatic. You can on occasion get maybe a 1 year agreement where you'll stay in place, where the new borrower will be able to observe and make a decision about whether we continue on or not. But there's no guarantee for.
Does the original owner ever take it back? The property, you have to work out his own problems and he gets it back? In those cases,
Well, I'm sure it does, but that hasn't been my experience in
I think
the New
the
York
answer
market.
to that question is if JLL is engaged by a servicer while the loan is still in place, they will come in through a court-ordered receivership order, right? And so they're obligated to the court. They're not obligated to the lender. They're not obligated to the borrower. They're obligated to the asset in that court order, right? So if subsequent to that, the special servicer / lender ends up working out some sort of a deal with the borrower that enables him to regain the property, JLL or whoever is serving in the role will still be subject to that court order and will work towards an orderly, wind down of the receivership. Maybe they get retained by the borrower, maybe they don't, but there really, in that instance, shouldn't be a conflict.
Much of that I'm seeing, just to step back a bit with regards to the maturity issues and potential maturity defaults, and and Ira could interject on this as well, is that there's a lot of tenancy role. I mean, let's face it, there were a lot of tenant leases done in 05, 06, 07, new 10-year deals that were lent on with 10-year loans, where there wasn't necessarily the foresight to say, okay, how do I get taken out of this loan? I have a new 10-year deal. So you'll have properties with 55% of the tenancy rolling, in addition to being unable, even if the tenancy stayed in place, to refinance for its current principal. In addition to all, CapEx issues, the fact that money may not have been put in over time, which I'm sure you see a lot. But what happens is two things. Number one, the cash flow may adjust itself. Number two, even if the roll is maybe a year or two out, new lenders, I'm assuming, would do holdbacks to cover, TI and LC, or maybe even more, for those tenants that are rolling. And I think, it's very hard. I think we had this conversation to quantify what exactly the role is going to be, how that's going to affect certain things, and how to quantify it with regards to rental rates in the industry. Are you seeing many guys coming to the table to refinance, and then all of a sudden they realize that they're going to have a $4 million holdback on a $20 million loan, and they won't be able to make proceeds?
Right, so that's happening. I think a lot of those deals are starting to either was finding people looking to sell, taking partners on those transactions, or they're not going to CMBS first. They're still first going to a bridge lender.
Mm-hmm.
And I think to talk regarding seeing how the loans are getting safer, there's a lot more bridge products. There's a higher leverage on the bridge product. There's more mezz players coming to the marketplace. So those situations, there are solutions for them, and we're working on a lot of those transactions to deal with these issues. Get it past that 12, 18, 24 months. Get it re-rented out. New leases in place, and then even if the debt yields are where they are, they could be able to refinance at that point.
What types of leverage are you seeing on bridge products today?
we're seeing anywhere from bank bridge products are 65, 70 they want to stop at. If you have now it used to be just take a bank loan as the first piece, 65, 70%, and get a mezz lender to bridge it to 80. I think what became more sophisticated now is that the mezz lenders or the bridge lenders start at 80, 85, and they sell off the 8 piece afterward. So certain lenders doing that in reverse. A lot of that.
We at C3 we're also in the mortgage origination and lending business, and really have two products. One is a fixed rate conduit product that we originate for sale, but we also have a bridge program where those loans we hold on balance sheet. They tend to be shorter term, variable rate, and in a lot of cases we may end up providing our own takeout at the end once the property is stabilized. But I think a lot of, ourselves included, a lot of the bridge lenders, mezz lenders, they come at it really from a principal and an owner's perspective, and they're making the loan, they're hoping that they get paid back, and the underwriting would suggest that they will get paid back based on the market and the conditions, but they also are looking at it from the standpoint that if they had to own that asset, am I comfortable at that basis? And I think that's what a lot, to your point, Shlomo, about maturities and refinancing, I think a lot of this stuff just needs to get recalibrated and the basis needs to get reset.
They don't lend to own; they lend and prepare to own. But we're finding that these lenders that are preparing to own is that I think there was an article. I'm not sure if it was in the Wall Street Journal or in Cranes that spoke about how could a buyer get yield today. So they're better off lending the mezz piece to 85%. And being able to earn 8, 10, 12% on their money, less risk than owning a property and taking all the risk for single-digit returns.
Listen, I have an ultimate issue with that thought process because I think, as Kevin could probably attest to, it's more and more difficult to foreclose on properties. Borrowers and borrowers' legal counsel, are getting way more sophisticated.
Borrower reps, by the way.
And I try not to talk about myself in public, but nonetheless, but borrower counsel are getting very aggressive. They know how to play the system. Mm-hmm. They understand that many judges don't have the familiarity with some of the complexities. The trustee, master servicer, special servicer, bondholder. Who was the transfer to? Was it transferred? There are so many issues. And dealing, again, with bridge, I understand it's not CMBS, but on the flip side, you can tie up litigation in court for a long time depending on where you're located, and you can bring up a lot of issues into court that could stretch it out. So I personally, I think that CMBS, the rates may be, from a risk-adjusted basis, maybe a little too low. Again, I understand the bond traders in the back end find a way to make all that up. But there is significant legal risk. I just don't understand how someone could go into loan to own and assume he's going to get that yield. He may sit here 2 years with his money tied up in a court proceeding and be unable to realize that yield. But then again, smarter than me, they're actually lending it, right. And sometimes they're successful and sometimes they actually are tied up.
So it's a good point. I think from their end of it, these lender borrowers, they were on the other side of the coin. The documentation that they have in many cases, they had their lawyers and they were fighting on the other side representing them, number one. They also have different springing guarantees. It's a different language, and I'm sure there are certain special servicers, and when someone comes in and says, I have a loan and the special servicer is X or Y, and you say, oh, forget about it. I'm telling you right now, they're just going to take back the property, and why? And depending on how you start the table, you know what you're going in for. When you're coming up against someone who perception and reality has what it takes to take it again, and probably smarter than the typical. When we used to pitch letting a lender say, why do you care if there's a mezzanine loan behind you? So what do you mean? There's more stress on the deal. You tell a lender, right now, you're lending to someone $10 million deal. $2.5 million your borrower, and you're putting up $7.5 million you're lending and $2.5 million of equity. Wouldn't you rather SL Green to let the person be there for the other million and then they are 15%? If there's a problem, SL Green's not getting wiped. SL Green will first cover you while they take on that fight, get protected, you're more protected. So the same type of concept that goes through. Don't forget they're leveraging their money. That little piece they're putting out there, from 65 to 80 really, they're making the yields are in the high double digits and sometimes in the high teens, or low 20s. So they could afford to wait, and there's buffer in the property. And when an owner knows that he's not going to win at the end, he'll give up a lot earlier. So we're finding some blend along those lines. But I think, Kevin, like you said, the starting process is the numbers really work. Someone bought a building for $10 million with a whole plan, They put in, I'm giving him $8 million, $8.5 million, and on top of that, he's got another few $1 million on top of that of capex he's putting in. You know, the deal should work to at least cover the $8.5 million.
But back to your original point, I mean, look, we're an industry, and I've said this many times, you know, we're an industry that's characterized by 7-year cycles and 5-year memories. and we constantly make 10-year forward-looking fixed rate
Right.
bets on historical data. So in 2005 and 6, you know, you had 10-year leases. Well, those weren't a problem because, as we all know, real estate only goes up in value, occupancy stays static, and rental rates go up. So no problem.
And expenses down.
And expenses are flat at best, right?
At worst.
And you're starting to see the same thing now. You know, everybody is starting to believe that we'll always be in an interest rate environment that's sub 5%, and we'll have cap rates that are sub 6%. You know, and so consequently, what ends up being sacrificed, I think, a lot of times is structure. And you don't put a lot of structure, as much structure maybe as you would like to, simply because the competition doesn't allow you to. Because somebody else will do that same loan for the same amount of proceeds with less structure.
Man's got to eat.
Sure.
I mean, you talked about where rates are going, and so I find it very interesting. You know, everyone obviously perception is rates are moving up. The question is when. I was in Cantor, and the head trader said that their belief is that you have a better chance of seeing a 10-year T-bill at 1.5% in the next 2 years than seeing 3.5%. So,
Believe it when we see it.
believe when you see it, but on the other hand, with difference today than years ago is that we're living in a global economy today. So in a global economy
Right.
where can you put your money, and
Right.
you have New York City pricing, who's to say, you know?
I heard a different argument. Rates will not increase by 200 to 300%, as if where we are now is the basis on which it's going to increase from. It's almost like it's not 200 to 300%. Maybe now it's 200 to 300% below what it should be.
Right.
And that's really the perspective. And I think it really comes down to, if there's someone willing to provide the capital to lend the money, then there'll always be someone willing to take that money. And that's the general issue that we've had, as you said, you know, the short memories and always projecting beyond what we can.
Well, and everything's a yield play today, right? I mean, everybody talks about, you know, searching for yield and you know, quote, as I said at CREFC a couple weeks ago, you know, I chair a forum called the High Yield Distressed Realty Assets. And I said, we're no longer high yield, we're just higher, right? You know, so it's all relative. And I said, you know, if it makes you feel better if you're a mezz lender, don't say that you're earning 8% on that mezz, say you're earning 800 over. It sounds better.
It's all about perception, right?